I can hear you, I think.
All right, it's 12 o'clock, so we're going to get started.
Okay, it's 12 o'clock. All right, so we may go ahead. Is it recording now?
Yep.
Okay, so we'll go ahead and get started with our investor class. And if people pop on, that's great. Tom and I are more than prepared for it just to be us on this. Yet really it's about the shareability of just getting this recorded. So I think that's what we'll just jump in and do. And as long as the waiting room is not activated, then I think we'll be able to just let people pop on and not have to accept them in. Awesome.
All right. So Joanne and I are going to share kind of what's going on in the market today and where we see things going and what opportunities there are. A lot of this is based on a book that was written called The Millionaire Real Estate Investor. I think those models that are laid out in the book are relevant in any market. So just kind of some basic principles that we're going to touch on, as well as what's happening in the market today. All right, so do you want to talk about our background real quick, Joanne?
Okay, well, and before I jump into just some background here, I think it's worth bringing up that a lot of people, the furthest thing from their mind right now is investing. I mean, just the amount of interest on this call proves that people aren't thinking investing, and so that's whenever you do what the opposite of the crowd does, that's when you're winning in the investment world. When the newspapers were sharing that everyone was buying beach property, you just probably shouldn't have been buying beach property. It's when you're not reading about this that you need to be doing it, and it's not ever a real popular move. So because it's not talked about very much, that's the main reason we should try to focus in on opportunity. All right, so presented obviously through our team, and this is our family photo here, but Tom and I were licensed in 2001 and 2002, and of course we're investors in the marketplace. And I forgot what that bottom piece was. It was a little delayed there. So we hold currently 8, has that changed? I thought it was 9, investment properties, and we flipped 3 properties in the past 24 months. We hold 14,500 square feet of commercial space. And of course, we operate the Curtain team here. We're a top team with Keller Williams Realty and Roswell.
So this is kind of a big picture, and we're going to break it down into what's happening today. But big picture, what we've seen, this trend line, what this is showing us is that over 2 million single family homes have transitioned from owner occupied to rentals. So what this means is that more people are renting single family homes than ever before. And that trend is expected to definitely continue. So what that means as an investor is that there's more people wanting to rent single family homes than there has been in the past. So you've always got kind of that market available. Mortgage rates, I'm going to let Joanne touch on this. This is a trend just showing back from 1972 to now, so you can get a flavor for just how great the rates are compared to historical averages over the last 25, 30 years here.
Yeah, so the over 50 years, the 30-year mortgage rate has literally just moved in unison with the 10-year treasury rate. I mean, that's no news. I'm not sure if the next slide is in this one, but what recently just happened, yeah, the circle, there we go. The circle shows what just happened to the treasury rate actually did not move in unison with the mortgage fixed rate. So, that actually broke the rule. And it just really changed the past couple of weeks. So that just right there proves why you really do need to have a trusted advisor, not just watching the news and moving with the crowd. It is leaning into a trusted mortgage advisor that you have used in the past, or if you need a recommendation, we can make a recommendation, but really need to know what is going on a local level specific to your loan.
Yeah. We saw the lowest rates back at the beginning of March. I think that caused a really big refi boom, which is the lenders are still working their way through right now. But the rates have jumped up and down, but they're back again to what is really the lowest we've seen in a long time, right? So we hit that all-time low, but they're still super low right now. So one of the things we were going to mention, if you haven't looked at refinancing your home, you definitely should consider that to free up cash flow. There's opportunity right now. We're going to talk about home equity, but there's opportunity right now to tap into that equity, whether that be for investing or just to have that peace of mind of having that reserve if needed. So rates are still super awesome.
Yeah. And Tom, can you see me on your screen? I can see you in the bottom corner. Oh, good. I can see you. Okay. All right. Yeah. So just on this chart alone, going back, well, that might come up on another one, but I don't know if anybody has a mortgage right now above what you're seeing here. You really do need to talk to your lender. Tom and I've gotten a few emails from past clients. They've just bought their properties or closed on the last few months, and they've asked us if they should be refinancing. So if your credit is there, it's definitely something to look forward to, because you can lower obviously your payment.
Yeah. One of the things we're going to talk about just as a macroeconomic is student loans. What we've seen with student loans, obviously you can see the trend here, how much they have grown in the past years, and what that has caused is later and later than average first-time home buyers, right? So Joanne, I think you talked about the last time how the average age went from maybe 23, 24 to now late 20s, early 30s.
Yeah, so I think it was we shared about some statistics on the millennials. The average age literally of buying a home was around the average age was around 23, 20 and 27. The husband was 27, the wife was around 23 or so, and now that's really shot up. So the wife's like 27, the husband's like 30. So it's all pushed up like 5 years, if not 7 years, for most newlyweds. And then of course, after newlyweds, here come the babies who need the house, and of course they need the house. So because that's all pushed out, we're not even at the age where those millennials are turning 30 yet. And so when that does occur, boy, are they going to be looking to purchase some properties.
But right now they're renting, so that's also what's leading to kind of that longer or greater percentage of people renting because the millennials are waiting longer to buy.
Mm-hmm.
So big picture, we don't see this as a repeat of what we saw financially 2008, 2009, 2010.
Mm-hmm. So this was a quote from Wells Fargo from the Investment Institute. And they, of course, don't expect it to be because the virus and oil stocks are not endemic to the financial system, but are rather external. So once the virus infection rate peaks, they say that then we'll expect a recovery to gain momentum into the final quarter of the year and especially into 2021.
Mm-hmm.
Okay, so this is the .com 911 crash. This is exactly when Tom and I got into the business. So we know this slide pretty well. To the far left, that shows what the stocks did. And a lot of people lost their jobs during this time in 9/11. I remember jumping into the business and it was an election year. What the talking point on this slide is that annual home price actually still appreciated during this time. Thank goodness. It just together was just under 20%, even though all of this happened in the .com crash.
Yeah. And then in 2007, 8, 9, which was a complete economic crash, what did we see then?
Yeah, this was a housing crash for sure. And yet, even though the 7, 8, and 9, all those appreciation losses, those did not cap out more than around 20%, even that. So I heard that this was more of scar tissue in comparison to the bleeding S&P had. Okay, so this was a Goldman Sachs gross domestic product forecast, and that's all related to the healthiness of our markets. So first quarter, going further into 2021, you see this is what I'm going to reference this in a minute, but this is the V curve. So when a pandemic hits, we see a V curve instead of a U curve. We don't have a chart for that, but the U curve is what we experienced after 2008 and 9, because 10 and 11 and 12 was just the slowest ride back up again above the line. And they're projecting here that quarter 3 is going to come back out with a 3% increase and then another 4% increase before 2021. Mm-hmm. This is a great slide. I like this slide.
Yeah. So we've kind of given an overview of what we've seen and what we expect to see, and want to just dive into kind of some more, I guess, specifics on really what it means to create wealth. So this is just one definition of financial wealth that we've latched onto. It says the unearned income to finance your life's mission without having to work. So right now, I know a lot of people are facing not having earned income available, and that's really what Joanna and I's mission around creating wealth through real estate is, that freedom, right, that it creates. And not even just freedom to go, travel the world or whatever. I would say it's more of that peace of mind, right? Just knowing that you have money that will come in, even when things like this happen, right?
Mm-hmm.
So,
and as a team, we all sat around together and went through expenses and just looked at expenses and personal expenses as well as business expenses. Everyone is looking at expenses right now. it's just a real healthy place to find security in an uncertain time. This gives security, if nothing else, that financial freedom that Tom just mentioned, that freedom to have peace of mind.
So this graphic demonstrates how we just finished up a book reading.
Here it is.
Wealthy, you got it.
Millionaire
Mind. So there's a lot of books out there. Rich Dad Poor Dad was the one that we started with, but a lot of books that talk about how you think about money and the philosophy behind money. And this graphic just demonstrates how the wealthy leverage their money. So on the top, that is how the wealthy handle their money. So they have, it says capital there, but think about that being like an asset or a house that creates cash flow, and then that produces cash, and then they'll consume with what's left from that. Whereas the opposite is true of those that are in Rich Dad Poor Dad calls it the rat race, where you're basically consuming first, and then you've got some cash hopefully left over that produces some cash flow, and then you would invest whatever's left. So it's just kind of
Tom, can you see the book?
No, I do not see the book.
I think I switched my camera.
Yeah, now I see it. Okay.
Okay, I knew that I did something wrong. Okay, so this is the book that Tom was referencing that we just did, and he mentioned the rat race, and we just can't talk enough about the game cash flow for your family, because it gives your kids a real hands-on experience of why it's not good to keep consuming. So that's been a great family activity. We're playing it quite a few times a week. Yep. The kids are asking to play it.
So this slide, cash flow is a great game too. I'm going to kind of digress. Cash flow is a great game too, because it really, it teaches through doing, which people learn in different ways. So you can read it, but I think when you play this game, it teaches you this without telling you directly that you can't save your way to financial success. So this is just a great example. I'll walk through here. So this example says, okay, how could I create through savings $100,000 passive income a year, right? So that would be, I'm putting money in the bank at a 4% interest rate, which would be a phenomenal interest rate to get right now. But this is basically the math for creating $100,000 a year in passive income after taxes. So it's making the assumption that you make $100,000 annual income. You are a great saver, so you're saving $30,000 of that. $30,000 is going to go to taxes, and you're going to live off $40,000. So after 10 years, you've saved the $30,000. Now you have $300,000. Okay, another 20 years, you're going to be at $600,000. 40 years, you're going to have $1.2 million. And after 80 years of working and saving, now you're going to have $2.4 million, which is the amount you would need to have in the bank at 4% to produce $100,000 annually. So I think just kind of looking at that, you realize that doesn't sound fun. That's not, saving and investing are really not the same thing, right? So investing is different than just saving your way. This is another way to look at it. Okay, so human capital is basically us trading time for money, and then capital assets means your money is working for you. So that would be, for example, a house that produces rental income. So your choices are, with the money that you earn, you can spend it, you can donate it, you can save it, you can invest it. Your investment choices, you can lend money, you can own something. Passively, if you lend money, that would be like lending money to the bank. So you're putting your money in a CD, bonds, stocks, mutual funds. Someone else basically controls it. If you're active and you own it, that means that you're owning a business, you own real estate, you're doing private lending or owner financing. So you maintain control of that. And then those are going to produce financial returns. So on the passive side, someone else controls your money, and on the active side, you control your money. It's a lot more difficult to get a good return and create wealth when you're on the passive side.
And that's what that cash flow game has taught the kids. It's really about getting out of that rat race. And I think the goal is the fastest somebody's ever gotten out of that on the game is 20 minutes. The goal is to get out within an hour. And one time we played it for 2-3 hours and nobody was out of the rat race. So that was funny. The kids and us were reminded you really have to be on that active side of investing to get out of that rat race. So you have to control it instead of being passive about it.
Yep.
And out of the rat race was just the freedom. That's what that is in the game.
So on this table, this is just a graph of investing, and across the top you've got 0 to 20%. That's your interest rate, and you'll see where you would be if you were investing $1,200 on an annual basis. So basically that's $100 a month, right? If you invested $100 a month, what would that look like after 30 years based on these different interest rate returns? So I think, a couple of things when you look at this, what I would conclude is how much you have to start with would make a difference, right? So if you were coming in at a higher number, obviously that makes a difference. Rate of return clearly makes a huge difference, and then time itself makes a difference. Anything else you want to add on that, Joanne?
I think that just speaks volumes. Somebody might want to screenshot that. That's a good one.
So getting back to real estate, this is just some national trends. Nationally, a little over 11% of all the 1 to 4 unit home purchases in 2018 involved an investor as a buyer. In Atlanta, 18.5% of the homes purchased were investors in 2018. We still have in Atlanta, well, not as of the last couple of weeks, but prior to that, we still have a lot of the large hedge funds that purchase homes here, and they hold those for their investors as rental properties. So we still see a lot of that activity, and they're buying hundreds of homes in some cases in a month. So another great statistic from this study was the median distance from their primary residence was only 20 miles. So for most individual investors, they're buying in their local market and kind of where they know.
And I was just going to interrupt only because I didn't want to forget this thought, Tom. I remember in the recession, you were talking about the rentals. In the recession, the rental homes rents were going up. They weren't so much going down. So that was even more of a safe investment to have a rental back then. And people were thinking, wow, I actually could rent a property instead of owning mine. And it was getting people to think creatively. So. Yeah.
Okay, and then the last point here in that study, of those who purchased an investment property, 73% had an annual income of $100,000 or less. So I think that debunks the the assumption that a lot of people have that you have to make a lot of money in order to be able to invest in real estate.
And in their recession, a lot of our clients at that time, they had never planned to be investors. They were forced into an investing. And so they couldn't sell their home, and we were doing the numbers for them. And it just didn't make sense for them to lose money when we could lease it for them for a profit, or at least a minimal loss per month, than taking a huge bath on it. So we actually closed, I believe it was yesterday, with one of those properties that was leased out. And then she didn't renew with the lease, and the property closed for a great profit. She was thrilled, and what a win. And she'd owned that. I think that was 2000. What year was that one? That was 2014, I think it was. Or no, it was way before that. Anyway, she was very thrilled, and we had multiple offers on it. So it ended up being a real win for her both ways.
This was from an article in Forbes magazine in 2018, but I think it all still holds true to 2020. One of the reasons Atlanta is one of the best places to invest is we have strong employment growth. We continue to see companies growing here, relocating here. A lot of companies from the West Coast are finding Atlanta to be a more economical place to operate, and we're seeing a lot of that shifting here. So we're very fortunate with the employment growth, and that in turn has led to rent and price growth. Those things really contribute to a strong rental market. Vacancy rates are super low, and here we still have manageable entry prices, meaning the home purchase price, when you compare it to West Coast or Northeast, our prices are still, I wouldn't say low, but manageable to come in, purchase at a price, and be able to make the numbers work with what you're going to get on rent. Real estate, in contrast to stocks and mutual funds, money market, is what we call an able investment, meaning the value never goes to zero. It can be leveraged, which we're going to talk about. So able meaning it's accessible, anybody can buy it. It's appreciable, increases in value over time. It's rentable, so cash flow, and improvable. You can put sweat equity into it. You can make the improvements yourself and add value. Deductible, depreciable, deferrable. There are great tax benefits. I would encourage you to talk to your CPA about what those numbers would look like for you. But that depreciability is one of the biggest reasons that wealthy people invest in real estate, because of the tax benefits it creates. And it's stable. I think we've got a slide coming up that will show just how it's slow to rise, slow to fall. Rarely do we get surprised by a real estate trend, unlike a stock market crash that, as we've seen, can happen very quickly. And last thing, it's livable. So, if everything just really goes downhill, then you can always move into your property. Okay, I love this slide because it really demonstrates the power of leverage, meaning the fact that you can borrow money to invest in an asset like this, and what that means over time. So this particular, just to keep things easy, we use $100,000 as the number, so your starting value. $100,000 stock investment, mutual investment, money market, and buying a property. So for the first three, you would have to actually have $100,000. With investment property, we know that they can be purchased with 20% down. So in this case, you'd only need $20,000 to purchase that investment property. Your carrying costs, most stocks and mutual funds have carrying costs in the ways of commissions or other fees that they charge, 1 to 4% annually. Money market does not have any fees, but on the investment property, your mortgage cost would be offset by the rent. So in theory, you wouldn't have any carrying cost there either. We do factor in, when we run numbers, we assume a 10% cost for vacancy and maintenance. So income, typically we see, this is just historic averages, 8% on stocks, 10% on mutual funds, and money market 2%. We have seen real estate appreciates on average in Atlanta 5% a year, every year. Other income, you're not generally going to see other income with stocks unless there's some sort of dividend being paid out. With investment property, obviously it's producing income in the way of rent. So you're getting appreciation and rent. So when you adjust your ROI, and I'm going to go into more detail on the next slide with that, stocks you're going to see 4 to 7% annually, mutual funds 6 to 9%, your money market's at 2%, your investment properties at 25% based on the appreciation compared to what cost you have in it. And then lastly, potential loss. Stocks and mutual funds can actually go down to nothing. Money market, there's no risk with that. Investment property, at the most, might drop 40%, and that's not going to happen in 1 year. I'm going to show you how we get to that 25% return. So if you've put $20,000 down on that $100,000 property, and we see a 5% appreciation in 1 year, that 5% is on the value of the house, the $100,000. So the appreciation that you have gained on your $20,000 is $5,000. So $5,000 is 25% of $20,000. So to make that same money in a mutual fund that is yielding 10%, you would have to have $250,000 cash. So most people, may not have $250,000 cash to put into a mutual fund, but they might have $20,000 to buy an investment property. Mm-hmm. So the other, this is just another way of looking at that appreciation, but you're also getting equity buildup in the property because you're paying down the debt over time. So your equity is going to grow through the value of the house is growing, and you're paying down that equity using other people's money, right? In way of rent. So you're paying down and gaining equity by paying it off every month, paying it down every month until you pay it off.
And this is why we say wealth can't wait, because it's about the time. That's the time piece. You cannot get that time back.
So this takes into account, you're also going to see rent appreciation over time. Rent has appreciated in Atlanta faster than just general inflation. So I think that the rent appreciation is a way to protect yourself against inflation. It's going to appreciate at least with inflation, if not more. So over time, your rent's going to grow, and that's going to allow you to create more and more cash flow over time as well. So there's, 4 big reasons people invest in real estate. Basically, less out of pocket, right? So we just saw how you can leverage getting a mortgage and not have to put as much in. So it's less out of pocket. Those tax write-offs that we mentioned, the depreciation. We saw the equity buildup that grows your net worth over time. So, over time you can choose, as our client did, to sell the house and cash out the equity. You can refinance that property when the equity is built up and take that money and pay for college. You can buy another property that turns around and pays for your kids' college. And we've got a friend who has 3 daughters, and he has to
He
pay
bought
for
a
3 weddings, right? So he was like, I got to buy 3, or no, he was going to, first he started out, he wanted 3 houses because he knew he had to pay for 3 colleges. And then he realized he needed 6 houses because he needed 3 more houses to pay for each of their weddings, right?
That's
So
right.
now his goal is 6 houses.
So going back to that net worth, growth through equity, if anyone has equity in their properties, you may get a peace of mind for just living in a house that's paid off, yet everyone can double their net worth right now if they refinance their property. You can double your net worth right now if you have equity and you're able to refinance, cash out, and use that money to build your net worth, or of course college, things that you've got coming in your life. But that's the big message with the refinance on what you already have as equity.
Mm-hmm. So some more on tax benefits. You can, again, see your CPA on this, but operating expenses are generally management fees. Those things are able to be written off. Your mortgage interest, financing costs, closing costs, the depreciation is a big one. Any capital improvements you do to the property, like new roof, siding, personal property, and then maintenance expense that you have ongoing, those are all going to be able to be written off. Excuse me. So this next part, we just want to get into kind of, I guess, the basics. There's 4 types of residential properties, and we're going to talk about each one of them. And what we see is kind of the pluses and minuses, starting with the condo. Condos are generally going to be a lower purchase price. The pro, is that there's no maintenance. Maintenance is usually included. You might have a little bit of interior maintenance. For the most part, you're not going to have maintenance costs. And there's generally an abundance of amenities, which can be attractive to a tenant. The challenge or the con with condos is that you have high HOA fees to pay for all those amenities and maintenance. So you're still paying for it. It's just a monthly HOA fee. So that equates to less cash flow. You only own a percentage of the land, and so there's generally less appreciation with condos. We've seen some condos that have had 0 appreciation, unfortunately, over 10 years. So
And with everything that's happening right now with the pandemic, the condos and we're going to talk about this with the next slide of single family, but because there's such shared spaces with vent systems and shared walls, just that safety feature alone is causing people to now put their money in single family. So this single family home investment is going to be worth more. Mm-hmm. Even in the future than they have already.
Yeah, so they're definitely easier to sell usually. The good thing about single family is you're usually surrounded by other owner occupants. So the neighborhood is going to hold its value. It's going to be a nicer area. So you see more appreciation with single family homes. And tenants in single family homes generally stay longer. They're a little bit more rooted when they move into a home than maybe a smaller condo. The challenge is it's only 1 unit to generate income. So if somebody moves out, then you've got 100% vacancy or loss of rent. The duplex, they're typically, we don't have a ton of those in Atlanta. We do, but not as much as other parts of the country. They're typically close to single family neighborhoods, less risky than a fourplex that we're going to talk about next. You're going to see more cash flow just because the cost is usually a little bit lower, and the rent to cost ratio is a little bit better with a duplex, but they're not going to appreciate as much, right? They're going to there's usually other rental units around, not as many single end users, so the value is just not going to be as great. And the last one is the fourplex or quadruplex. they are usually really high cash flow. Your financial impact when one unit goes vacant, then you've got 3 other ones still covering expenses, and the economies of scale, meaning if you have to replace the roof, you're basically replacing the roof at all 4. If you're painting, you're painting the whole building. The challenge is you've got more upkeep. The tenants usually do more damage in these types of units. There's more turnover, less appreciation, and tenant conflicts can be an issue depending on your So
and seller conflicts if they're all if you're in buying it with friends.
well, you're generally with a fourplex, well, almost 100% of the time you're selling to another investor. So versus the single family, right, where you're selling to an end user, they're going to pay kind of that full retail, right?
Exactly.
Whereas another investor is going to come in and not, want to pay as much. So that's one of the reasons that you don't see as much appreciation here either.
But the cash flow is really high.
Quick, this is just a success story. Just I love to share this because it's actual numbers here. On this particular one, this was a townhome that is this Marietta, Smyrna? I know
Yep.
it's close to the Braves stadium.
Yeah, it's Marietta.
Okay.
Yep. Yeah. So
Um,
this was a great success story, mainly because this home was sold at one of our investor workshops. When we shared it, we had a purchaser right from our team that came in, leased it, cash flow positive from the very beginning. So this was someone that was either going to let the property just go and have major disrepair and lose money, or they were going to have our team help them renovate it. And gosh, we'd love to see some inside pictures of that because it was beautiful once we finished, and it was just turnkey. So we had a purchase price on that of the $231. Repairs we estimated $3,000. This was a very conservative projection for the purchaser. Vacancy carrying costs $1,800. The down payment $46,200. Monthly payments $1,180. Monthly income, so you can see there the expected monthly cash flow was $470 out of the gate. I think Tom and I's first investment property we bought, we made $30 on it back in 2002. We thought that was awesome. We were winning.
Well, again, with the climate that we're in right now and people facing job loss or just reductions in income, that $470 a month can make a huge difference. If you just had that as a supplemental income, even if it was half that. I think, I read somewhere in an article where on average, $300 a month can be kind of the make or break for some families with just trying to get by with bills. If they just had an additional $300, like what would that do? So anyway, all right, so home price changes during the last 5 recessions. Joanne, I'll let you kind of jump in.
Yeah, so this one, we've been through during the last 5. 3 of those actually had positive home price changes. So that's just good to see.
And again, the last one was a housing and mortgage crisis, right? Which this is not.
Right. Okay. All right. So this one is so powerful. Total equity cashed out. So, we just said, hey, you should, 50% of, you can double your net worth by 50%. Refinancing, cashing out your house. And you're probably thinking, oh, heck no. That's what everybody did back in 2008. And the last thing I'm going to do is use my house as an ATM machine. Well, if you look at this chart, this graph on the left side, then people did use their house as an ATM machine. Look how many billions of dollars were refied out, 824 billion. Today, I mean, it's just piddly compared to that. I mean, it's 232 billion that was cashed out. So people right now, they have 50% equity in their homes. 50% of all the properties have 50% equity. People were willing to walk away with no equity back then because they had used it as an ATM machine. They had no asset. They're throwing the keys in an envelope and sending it to the bank. Today, people aren't walking away from their homes if they've got 50% equity.
We're not going to spend a lot of time on this, but we have lenders that we can refer you to if you want to just kind of talk through some numbers and understand whether you qualify, talk about the advantages and disadvantages of 30-year versus 15-year, whether you'd want to put a little more than 20% down to better your rate, those kind of things. And then also thinking down the road, if this is your second property versus your very first property, then how does the lender look at that rental property? How do they use that rental income in qualifying you for your next mortgage? Property management versus self-management. Pluses and minuses here. Obviously, self-management, you're not going to have the property management fee with that, but with that, then obviously you have the full responsibility of managing the tenant, collecting rent, managing repairs, which is a big one for some people. Property management company, if you do use a property management company, then they are going to be responsible for collecting rent, evictions if that were necessary, managing repairs, getting vendors out there when things are needed to repair, and leasing the property, marketing the property, showing the property, leasing the property, all of that stuff. All right, next steps, read MREI, Millionaire Real Estate Investor book. That's a great one. Mortgage professional, again, we've got folks we can refer you to. I would also encourage you to talk to your financial professional to understand what capital you may have access to. There's certain rules around, depending on what kind of retirement fund you have, if that can be used with real estate investing. And then we can get together virtually, right, Joanne?
Mm-hmm. Yeah, so that's the market of the moment right now. We miss everyone. We miss everyone. We are going virtual though. We've got a lot of wins because of it. So we really want that to be the message to everyone. And our team, we've got 9 members on our team. Our project management has contractors, color selections, products, budget consulting on how we can make your goals happen. And then of course our leasing and services and property management, find quality and place the tenants. So big one, quality tenants. Property management, collecting rent and handling repair requests. So our property management company is called Create Wealth Property Management. That's a little too small to see. Got the glasses on. Create Wealth Property Management. So please reach out to us, phone call, or we can even do a walkthrough virtual of a property that you've got questions on. Okay. All right, guys. Thank you for tuning in. I want to make sure this book was able to be seen now that I can see myself. Make sure y'all. Secrets of the Millionaire Mind. We just read that as a team read, and we wish everyone well and growing your wealth through real estate. Thank you.
All right.